Good morning, everyone. We're going to get started in just a few seconds. Hello, everyone. Just a quick note that we've emailed everyone a copy of today's slide deck if you want to reference the slides as we move forward. So I'd like to welcome everyone to the Bober, Markey, Fedorovich, Oswald, and Vining's presentation of Reversing and Remedying Discrimination Against Key Employees, presented live on October 27th, 2021. Thank you for joining us this morning. During today's session, we're going to cover tax considerations for businesses, lessons learned from qualified plan audits, how to manage and mitigate risk, as well as impacts to funding methodologies. If you're listening to us live, please use the Q&A function to submit your questions and we'll address them at the end of the discussion. If there are any questions that require an in-depth response, we may follow up with you offline so that we can dedicate the appropriate time and attention to your inquiry. This live presentation qualifies for up to 1 credit hour of CPE. To qualify for CPE, we'll be providing polling questions across this presentation, which will need to be answered during the webinar. This presentation is also being recorded, so if you need to drop off, you'll be able to review the presentation at a later time. If you're watching the recorded version and have questions, you can email your questions to any of our speakers. To get things started, I'd like to introduce Mark Burns, Chairman Emeritus of Oswald Companies. Mark merged his employee executive benefits and retirement plans firm, Mark S. Burns and Associates, with Oswald in 1987. Mark served as the company's chairman and CEO for over 2 decades. Today, Oswald is ranked the 33rd largest insurance firm in the country by Business Insurance. Under Mark's leadership, the firm's executive benefits practice has excelled in serving Fortune 500 and large, closely held corporations. For over 45 years, Oswald's team of experts have creatively designed many innovative, non-qualified plans by leveraging the insurance markets and cost, efficiently delivering cutting-edge products. And with that, I will turn things over to you, Mark.
Thank you, Stephanie, and welcome one and all to our webinar today, featuring industry experts from Bober, Markey, Fedorovich, Vinings, and the Oswald Companies, focusing on strategies to reverse and remedy discrimination of standard employee benefit and notably retirement plans for key employees. As many of you know, most basic group term life insurance, long-term disability, and retirement 401k and 403b plans impose caps on covered compensation that markedly discriminates against your company's highly compensated employees. Historically, we at Oswald have innovatively designed and cost-efficiently funded supplemental, non-qualified life insurance, long-term disability, and deferred compensation plans for many of our clients. Today's focus will be exclusively related to new guidance issued in June on how the IRS will now audit non-qualified deferred compensation plans and why our firm's collective horsepower can not only help you mitigate audit risk, but assist you in either A, restructuring, or B, designing new plans, providing safe harbor protection and preserve the integrity of said plans from IRS and Department of Labor scrutiny and or penalty. Allow me to introduce our star-studded panel of subject matter experts. First, Jim Merklin. Jim is partner in charge of BMF's employee benefit plan practice. Jim is the past executive committee member for the AICPA's Employee Benefit Plans Audit Quality Center and past speaker and member of AICPA's Employee Benefit Plans Expert Panel. Jim is a nationally recognized speaker on employee benefit plan audits. Dave Kolchar, co-founder, Oswald Financial, is a retirement plans industry pioneer, the recipient of numerous financial advisor awards Dave leads a team of retirement plan experts dedicated to servicing our clients' 401k, 403b, and deferred compensation plans. Ken Kirk, Chairman and CEO of Voluntary Management Corporation, based in Atlanta, is a nationally renowned consulting firm, providing strategic design, financial analysis, communication, and ongoing administration for executive total reward and retirement plans. Vining's clientele is incredibly impressive. It includes Fortune 100 and major privately held corporations. Ken's remarkable career includes leadership roles with Clark Barnes, Mellon Financial, and he also served on the board of the prestigious Buck Consultants. A published author in numerous CEO and CFO publications, Ken is a legendary speaker on the topic of executive benefits. And I have personally had the distinct privilege of working collaboratively with Ken for over 3 decades. Now it's my pleasure to introduce Todd Wagner, Managing Partner of BMF's Cleveland office and partner in charge of its tax practice services. Todd's expertise lies in the area of financial, estate, and business succession planning and creating merger and acquisition strategies related to valuation, transaction, and negotiation deal terms. Todd, the screen is yours.
Thanks, Mark. Appreciate that introduction. And welcome everybody to today's session, which is intended to be a proactive look at how your company can mitigate audit risks to your non-qualified deferred comp plans and enhance the benefits of those plans. Before we get into the details, I wanted to share some background and high-level perspective, including some history as to how regulation of plans has evolved over time. What most people would consider to be the clearest regulation in benefit plan oversight was the passing of the Employee Retirement Income Security Act of 1974. I know that's a mouthful, but that statute provides the foundation for most of the regulations in this field today. The most heavily regulated sectors of benefit plans are qualified plans, and I'm sure everybody's familiar with those, either defined benefit or defined contribution to participants through some form of funded trust arrangement is the common structure. And these qualified plans also, for the most part, provide benefits to substantially all eligible employees, and they generally cannot discriminate in favor of highly compensated employees. Qualified plans have been regulated for many years, and the regulation includes annual audits by independent CPAs, like BMF, for those plans that have more than 100 participants. There's also significant oversight and an audit by the IRS and the U.S. Department of Labor. The IRS and DOL conduct examinations of these qualified plans for compliance with rules and regulations. And when they identify problems, they require both corrections to the plan and potentially significant penalties for the employers. And what we've seen is these examinations have been increasing of late. In a worst case scenario, these plans can be disqualified by the IRS, which would mean that all the contributions to the plan on behalf of the participants would be taxable income to them. And in addition, the income of the plan would be taxable income. Now, I know this is a worst case scenario, and our experience is the IRS generally will not disqualify plans as they really don't want to hurt the innocent participants. But what they will do is use the threat of that disqualification to levy significant penalties on plan sponsors. As Mark referenced, recent development is that this past June, the IRS issued audit guidance for non-qualified plans, including deferred compensation plans. These plans are generally covered by Internal Revenue Code Section 409A. Sorry to throw code sections out there, but they're typically designed to provide benefits, as Mark said, to top-level executives. Since these employees are generally considered a discriminatory group, there are very stringent guidelines on how those plans are structured and operated to avoid having current income recognition to the participants. Historically, the IRS has periodically looked at non-qualified plans when they do corporate audits, but it appears that they're now posturing to more aggressively seek out and audit these plans just independent of the general corporate audits. I'm sure everybody's been following the stimulus and infrastructure legislation that's currently in the works and making its way through Congress. And while we don't have specific details of how the Congress plans to pay for all of the spending that's in those plans, we know that there are going to be various tax increases, but also Congress is bolstering IRS funding and expects the service to be a larger generator of revenue. I'm going to now turn it over to Jim, who's going to share more about audits and compliance for these qualified plans. Jim?
Great. Thank you, Todd. Before I get started, we're going to do our first polling question. So Stephanie, if you want to go ahead and push that out. We'll give you about 10 seconds or so to respond. Another couple of seconds, and then we'll push out the results to you. And there are the results. 69% of the folks have plans that require an audit, and most of you have not been through an examination either by the IRS or the DOL. So we're going to talk a little bit about that as we proceed on. All of the qualified plans, we're talking about 401k plans, pensions, health and welfare plans, ESOPs, and there are other types of qualified plans. They all file an annual report on the Form 5500 with the U.S. Department of Labor. And as such, their information is public information and is subjected to oversight by both the Department of Labor as well as the Internal Revenue Service. Next slide. Funded plans that have more than 100 people are generally subjected to an annual audit by CPA firms like BMF. These audits are generally guided toward accurate financial reporting for the plans. And while auditors may detect errors or irregularities during the audit process, their procedures generally are not designed to provide you with assurance that there are no operational errors in those plans. Now, there are also certain types of funded plans that would have less than 100 people that may require audits depending on what the plan is invested in. It's a little outside the scope, so we're not going to spend any time on that today. Next slide. When operational errors are detected during the audit process, we generally will work with our clients and their legal counsel to be able to take advantage of the various voluntary correction programs that the Department of Labor and the IRS have to offer. So I want to talk a little bit about what those programs are. First, under the IRS's programs, they do have a self-correction program that is designed for insignificant operational errors. It also provides for, if there are significant operational errors, that you're able to correct before the end of the second plan year after the failure occurred, or they do provide language that says substantially corrected within a reasonable period of time. They don't quite define reasonable, but I'd say safe harbor is second plan year after the failure occurred. If there are ADP, actual ADP or ACP testing violations, those can be substantially corrected before the end of the second plan year following the plan year that includes the last day of the additional period for correction that is permitted by IRS. I know that's a big mouthful. But again, generally they give you a couple of years to correct it after the error would have occurred. Also, you can do self-correction for plans that were acquired in corporate mergers if it's substantially corrected before the end of the plan year that begins after the business transaction. The IRS also has a voluntary compliance program. Filings must be made for errors that are not eligible for self-correction. When you go through the voluntary correction program, there's a fee that you have to pay to the IRS. It's generally paid by the plan sponsor. The plan cannot pay that. That fee is generally dependent on the size of the plan in terms of the plan assets, and it generally ranges anywhere from $1,500 to $3,500. Lastly, if you're going through an IRS audit and errors are identified during the IRS audit process, you can negotiate under the audit closing agreement program with the IRS. What you'll find is that the penalties that the company will have to pay in that process, they will be more than under the voluntary compliance program, but less than if the plan were disqualified and taxes, penalties, and interest were incurred. Next slide. Then the Department of Labor has voluntary correction programs as well. Theirs generally take two forms. One is the Delinquent Filer Voluntary Compliance Program, which allows plans that have found that they forgot to file their Form 5500, or they file late, or they found that they may have thought that they filed an extension, but then found later that they accidentally did not. Well, they can file under this delinquent filer program and really subject themselves to a significantly reduced fine. The fines for late filing are pretty significant with the Department of Labor. The reduced fines are $750 for a small plan filing, and if you have to file multiple years, that can go up to a maximum of $1,500. For large plan filings, and again, a large plan filing is any plan that has 100 or more participants. It would be a $2,000 fee for filing under this program. And again, if there are multiple years that are being filed, it'd be $4,000 of the maximum penalty. Additionally, one thing that is out there are top hat filings. Top hat filings are non-qualified plans required when they are initiated to file a top hat filing with the Department of Labor. And if you found that you did not file that, you can file under the delinquent filer program for $700 filing fee. The Department of Labor also has a voluntary fiduciary correction program. There are 19 specific areas that the Department of Labor has defined that can be corrected under this program. And those are things like prohibited transactions, delinquent participant contributions, improper plan expenses, wide variety of different areas that you can correct issues with the Department of Labor. I should note that neither of those programs can be used if the Department of Labor has contacted you and started an examination on your plan. Next slide. In general, when you're looking to make corrections to a plan, there are three specific principles that you would look to follow. First is you're looking to restore benefits. The idea there is that the correction would restore the plan and the participants to the same position that they would have been in had the failure never occurred in the first place. Second is reasonable and appropriate. Depending on the nature and the type of the failure that occurred, more than one correction method may be reasonable and appropriate. It's more of a facts and circumstances type of situation. Finally, consistency. Correction and the earnings determination methods should be applied consistently for all such failures, and correction has to be consistent with IRS's published guidance. Next slide. In our experience in doing audits of benefit plans, we've seen lots of areas where errors will occur. On this slide, and I'm not going to go through all of these with you, I've just highlighted a number of the most common. The most common one that we see are late or missed deposits of employee withholdings. That, by the way, is the first thing that the U.S. Department of Labor will look at when they conduct an examination on your plan. We find participant loans exceeding the maximum allowable amounts, contribution errors due to use of the incorrect definition of compensation, and then several others that we've listed on this slide. Next. So qualified plans that don't correct would be subjected to penalties. If they're just late filings of returns, for those returns prior to December 31 of 2019, the penalty was $25 a day up to a maximum of $15,000. However, starting in 2020, the Department of Labor decided to jack up those fees to $250 a day up to a maximum of $150,000. So you can see here, with regards to that delinquent filer program, that you're gonna hit that maximum amount that you would otherwise pay, $2,000 for a large plan. You're gonna hit that pretty quickly. It's really only 8 days. Failure to file would also be subject to penalties. So there is a very important distinction between late filings. Late filings means that you've gone ahead and filed a 5500 as opposed to either the DOL or the IRS catching you on failure to file. The penalties are a lot harder on that. Next slide. With that, I'm going to go ahead and turn this over to Mark and Ken, and they'll go through their materials.
Well, that we Dave and Ken stepping in for Mark here, but thank you very much, Jim. That was well done, and thank you for joining us today. We're going to be talking about, next slide, please, and let's drop one more. Thank you. We're going to talk about the non-qualified plans and why they are so popular today. But first, I want to get into, the biggest trends that are out there, or the buzz that is out there, and that's all centered around plan success. And plan success is centered around the 401k plan. And what I mean by that is that there's a huge trend of people going to safe harbor plans to avoid the ADP test, the amount of money that the highly comped can put in versus the non-highly comped. The second big trend out there is doing what's called a stretch match. And the stretch match is trying to get the participants to save at a greater percentage so that they can more fund their retirement plan as well, not just depend on the employer dollars. An example of a stretch match would be, instead of 50% up to 6, it would be 25% up to 10, something like that. So to try to get them to save more. The third trend out there is auto enroll, auto escalate, and auto invest. That trend, all of these are trying to get around what's called the ADP test, which is how much people can put into, highly compensated people get restricted on what they can put into the plan. So all of these things turn out that they help the participants more than they really help the highly comped, because then with the highly comped, it becomes the dollar issue that is the restriction on what they can do to reach a sustainable and high replacement ratio for the highly comped. And that's what's made non-qualified plans so popular. And we're going to get into the detail of that between Ken and I. And a big example of that is on the next slide. So Ken and I put together a chart here that shows you how the areas that you are discriminated against as your highly comped or your key people. Social Security, if the chart was go farther to the left, you would see that that the replacement ratios for Social Security for the lower paid people can get as high as 70% replacement ratio. But as your income grows, the Social Security system, and whatever opinion you have of the Social Security system going forward, is still discriminated against the highly comped. The second is the 401k. As you can see in the blue section there, is that the more income you make, the more of the restrictions they are, because the dollar restrictions you could put in the 401k plan, the 19,500 plus the catch up if you're over 50. So really the shortfall here is getting into, how do we replace that big red box or the red portion of this? And that is done, in the most popular way that is done is through non-qualified plans. And we can dig into some of the basics of non-qualified plans on the next slide. When you get qualified plan, a non-qualified plan, you get a very tight little box. We're dealing with ERISA. So ERISA has got a lot of restrictions in there that limits the flexibility to the highly compensated folks. So we have to deal with all of the issues under ERISA. There are some things and variations that we can do that we're not going to get into today, but if you have the proper defined contribution, that's 401k plan or 457 plan, you can get into some defined benefit carve-out plans that can do some really creative stuff to try to alleviate some of the discrimination as well. But your demographics have to be right to accomplish that goal. So the plan, when you still have to meet the stringent retirement requirements within the ERISA boxes that we are dealing with. But non-qualified plan takes us into a whole new world. And I think when you talk about plan design, it's really different. On the 401k side, we're dealing with almost checking off boxes and living within the rules of, what's the waiting period? What's this? What's that? When you get into the design, and Ken's going to get into this very deeply, it's almost like, and it surprises folks that don't have a defined, a non-qualified plan yet, is okay, instead of that little box check thing we have going on, just pull out a blank piece of paper and tell us what you want to accomplish. And then someone like Ken can figure out exactly how to accomplish those goals. They're not subject to statutory limits, and we get kind of surprised to people that don't have non-qualified plans at this point, is there really is no dollar restrictions on this. You can really work well with, trying to control your personal tax. If you see yourself going to make $1 million next year, up from 500,000, you can defer that out into the future. And Ken, do you want to get into a little bit about the funding requirements and 409A and those things?
Sure. One good example of what Dave was just talking about, the flexibility out of a large client who was growing. They were looking for management talent. They were hiring at the very senior level, and they were in a market that was requiring signing bonuses. And a few times they had paid out some big, basically signing bonuses. The person was there a year and they left, and the signing bonus was gone. So what we did was basically take the signing bonus and say, yeah, that's yours. It's going in the deferred comp plan. You've got to be here 3 years to get it. And then it's going to be paid out over the next 3 years. So they put some hooks into the signing bonus, and they really like that. Unlike the qualified plans that have basically a separate trust to fund these programs, and those are tax advantaged. In a non-qualified plan, that's one thing you do not have, is basically tax advantaged funding. Generally, these are funded through a type of trust called a rabbi trust. It's a funny name, but it was because of a case between a rabbi and his synagogue that where the monies were set aside to protect those for the rabbi. And basically, monies can go in this rabbi trust and protect everything except for bankruptcy or insolvency. One of the issues there, I'm sorry, go ahead.
Ken, I was just going to say, if you want to elaborate a little bit more, we are seeing a lot of non-qualified plans set up for just what you spoke of, and that is a signing bonus. And you might want to touch on the base of how long that could put a golden handcuff on somebody, so 1 year, 2 years, or unlimited, that type of thing.
Well, the one we put several, and one of them had basically a three-year cliff vesting that they had to stay there for 3 years, and then it was 100% vested. And at the time the signing bonus went in, they were able to elect whether it was paid out then or over a different time period. You could put different vesting schedules. You could do if you were there a year, you get 30%, 2 years, 50, etc. So you have a lot of flexibility on that.
Yeah, and I think the other thing with the vesting on that is that you can do it from point of deposit, not like you can do in 401k plans, where it has point of starting with the company, and you can really stretch it out as long as you'd like.
Yeah. So because these plans the trusts are taxable to the plan sponsor, to the company. If it's a taxable entity, generally they want the assets in the trust to be tax managed. Over the years, one of the most prevalent forms of tax management was basically taking the mutual funds that are used in the plan and wrapping those in a corporate-owned life insurance wrapper, as it's called, so that the earnings on the plan become tax deferred, or if done properly, could be tax-free. They can rebalance within the insurance contract, and that has become probably the most prevalent form of funding, that and mutual funds that are taxable. And we'll talk in a few minutes about a very large opportunity that some changing regulations have opened up for those that are funding their program. Stephanie, at this point, could we go ahead and do the first poll? I think it'd be a good time for it. So this is just whether or not you have the deferred comp plan, or another type of supplemental plan called a supplemental retirement plan, or a SERP. That basically is a retirement benefit for top management that is funded by the company. Used to be those mirrored defined benefit pension plans. But as those have lost favor, so have basically the entitlement SERP, that you stay there and you get it. Most of the SERPs, I think all of the SERPs we put in the last 4 or 5 years have been performance-based SERPs, so that basically those accrue based on performance. So there's a good percentage, 64% of the participants do have some type of plan. Good, thank you. All right, why don't we go on to the next slide? So generally, these plans are put in for these 4 main reasons: to recruit top managers, to keep them there, so they see that they've got a way forward on the retirement side, to use performance incentives on the match or on the actual payment of the benefit based on performance, and then really giving an effective way for senior people to retire, to make up for that red area that Dave showed in the previous chart. Okay, go on to the next, please. These are some of the top reasons that we've seen in the marketplace of why these plans are used: help for savings, provide a much more competitive package for senior management to retain. You can read through these yourself. I think 2 of the key things are at the bottom, is that clients find these, or companies, plan sponsors, a very valuable recruiting tool. And if you don't have it, it's going to be, it's going to put you at a disadvantage, and then also to retain people. So those are some of the key reasons. Go ahead, please. So the way that we're that Dave and I are going to kind of go through some of the new ideas, some of the risks, some of the things that you might want to pay attention to, are through some real live case studies that Dave and I have seen with our clients. So let's go on to the first one. Why don't you talk a little bit about this, Dave, and kind of the need for having a plan to respond to some of the testing issues?
Yeah, this is actually a pretty successful 401k plan when you look at it. When you get the highly compensated to be able to defer at an 8% of their salary, but still, as you climb up on the income side of that, you're still being restricted against on how much money you can put away, and the percentages get larger the more you make. So it's actually a successful 401k plan, but it needed to have some significant changes, and the non-qualified area was the one that we could solve that problem with. And you might want to go in a little more detail on that, Kurt. Ken, excuse me.
Yeah. What because of the very low ratio of HCEs, highly compensated employees, to the non-HCEs, they did put that cap on the plan. And if you look at that kind of the blue area on the right, so that kind of starts with people at $140,000 on up, to get to that kind of the recommended target of 15% of savings. There was a very large group of people that weren't going to get to their retirement goals, or at least their contribution goals through the plan. Go on to the next slide, please. So what they did was they basically used their deferred compensation plan as a solution. The plan was designed to basically make up for any of the shortfalls in contributions because of the cap, to increase the amount that participants could put for both salary and bonus. One of the things that the participants, of course, weren't very happy about was that they were losing the company match because in the 401k plan. So the company made up all of that match that was lost in the deferred comp plan, and they also designed it with a kind of an innovative feature that allowed participants to take in-service distributions, so that in the 401k plan, if you're taking out pre-retirement distributions, of course, it'd be taxable, but there's also a penalty. In a non-qualified plan, you can set it up so that participants can save for different life events, college education, the dream home, the trip around the world, whatever it might be, and these can be distributed pre-retirement, and that's what this one client did. And if you'll go to the next just phrase, and this plan was very successful. The deferred comp plan has about 72% Actually, maybe it's maybe up a little closer to 75. It looks like this year, utilization and the actual contributions to the plan have been very high. They communicated the plan very well, and I think that helped. That there's a lot of understanding of how to manage the program. Let's go on to the next, please.
And do we
This
want
next-
to do the next polling question before we get this started?
Yeah, yes, please. Thank you. Yes. So this question is whether or not you have a rabbi trust and are funding your program, your deferred comp program or SERP or anything else you have in the in a rabbi trust.
So I think 62% of the folks have one. So we're only going to get responses from 62% of the followers today.
I probably should have worded that better. That's right. For those that have.
Yeah, you got it. Well,
All right. So we see that, I guess, four are funding their program. Okay, good. Thank you. For those that are funding or thought about funding, as I mentioned earlier, one of the most prevalent uses or forms of funding a rabbi trust is through corporate-owned life insurance. Those products have been refined over the years to have either no commissions, low commission products, very lean expenses from the carrier side and charges. In this year, a new regulations went in through the CCA that significantly changed the pricing of these products. Over the life of a participant, it will reduce basically the mortality charges, the COI or the cost of insurance charges in these products by about 50%, which is very significant. And this will also translate into very significantly improved financial performance of these COLI products. Next, please. And basically what happens, these products are rewritten with new products issued after January of this year. And then that's on actives, and for participants that have left, basically those are managed to basically minimize the mortality charges in those products. Next slide, please. This is for one of our existing clients that had about $70 million, the first column, in the existing policies. After just restructuring it, keeping everything the same except for the new pricing that was available this year, it was basically a $2 million increase in P&L and asset value in the first year. And over the 10-year period, it was going to improve the performance by about, on the bottom right, about $14 million, which is very significant. So if any of you have any type of corporate-owned life insurance products, whether in a rabbi trust or not, the carrier or the agents haven't brought this to you because sometimes status quo is their incentive. Sometimes you might want to make a note to take a look at this and see if it help improve your program. Next slide, please. This is a case study of a client that basically had a rabbi trust. And they wanted to, they had put it in, they were in the middle of a takeover attempt. A rabbi trust was put in very quickly, maybe 15 years ago, and they never looked at it since. They did not look at the document. They didn't look at the provider. It was the same provider as their 401k plan. So they thought it was time to take a look at it. They had about $40 million in the trust itself. They knew the trust was not synced up with 409, the regulations on their non-qualified plan. So they knew that had to be fixed. One of the things we found was that they were paying $325,000 in fees in the plan. It was basically it was assessed through plan assets, through asset management charge, and it wasn't specifically noted. So they were a little surprised, and we're able to reduce and negotiate that down a couple $100,000. I think maybe more importantly was that the purpose of a rabbi trust is to be there to protect participants if there is a change of control. And if there's a change of control, you don't want to have future management basically tell the trustee, don't distribute monies, don't pay out benefits. And so what really needs to be done on a change of control, you need a trustee that will become a discretionary trustee, so that they take discretion over both the investments and the distribution of benefits. In this particular case, it was the same trustee that was their 401k provider, and they said, we will not be a discretionary trustee, will not take that on. Whoever the current management is, we will take instructions from them on what to do. So please, for those that have rabbi trust, make a note of that and make sure that you have a discretionary trustee powers. Next slide, please. Bottom line on this one, that the overall expenses of the trust were reduced by about $400,000. It was brought into compliance, the 409A, and basically management now put together for the trustee a very well thought out strategy of what should be done with both the investments and distributions of benefits if there is a change of control. So it was a very significant overall improvement in this trust. Next slide, please. The next was basically a diagnostic of the plan funding that they had. Some of this was in a rabbi trust. Some of it was just on balance sheet funding. That basically they asked us to come in and look at the COLI funding. It had been in place for about 10 years through a broker who had helped design the plan and the funding. They thought it was fine. They didn't think anything was broken. They didn't seem to have any problems. And they thought, well, it's just good to have a third party come in and take a look at it now. What we did find was that the broker had basically represented to them that institutional products, kind of best in case products, had been utilized. What in fact had happened was that a retail product was utilized, not an institutional product. It had very high commissions, high carrier charges, and was just not at all cost effective, or as cost effective as it could have been. And basically they exchanged those for a private placement institutional product that had no commissions and was a significant improvement. Basically the plan itself was updated. We put in-service distribution, improved the investment choices for participants. We put in some really, I think, nicely designed asset allocation funds and alternatives through their investment consultant. And let me just stop there, Dave. I know you guys do a lot with your clients on kind of the investment platform within these non-qualified plans and target date funds and asset allocation funds. So I thought you might like to comment on that.
Yeah, although it doesn't fall under the code ERISA and fiduciary, but we treat every non-qualified plan as if it is a fiduciary plan. So we set up the meetings to run through the design of the plan. We monitor the investments to make sure there's best of class investments, for what's being offered to the individuals, and then supply a lot of educational guidance and coaching, and assign a money coach to every single plan to make sure that each person gets enough assistance to optimize whatever investment vehicles are there. And Ken, I'd go back to you for just a second, and maybe you could spend just a little bit of time, because you talk a lot about COLI, and COLI's a solution most of the time, but I know that you guys always look at regular funding with mutual funds versus COLI to make sure that actually is the solution.
Yeah, I mean, COLI is a tool. I brought that up because it's a prevalent tool. There are many situations where COLI is not used, should not be used, and basically companies mirror the asset allocation of participants using the same mutual funds. Some companies put in plans and don't even fund. They don't have to fund. The risk there is that you have a lot of interest rate risk, investment risk that the company is basically taking on their own if there's market changes that they don't have funded. So COLI is a prevalent tool, but so are mutual funds, or in some large plans, tax managed separate accounts are utilized also. And so for those that have funding or think, well, maybe we should look at funding to see if that's prudent. There are a lot of different alternatives that need to be basically compared based and then the results are based on taxes and cash flow and risk and a lot of different things that you'd want to look at. Mm-hmm. Another thing that we found as we went through this plan was that their plan document that had been designed was perfectly compliant. The plan design was done by a really fine law firm. Everything in the plan document was 409A compliant. However, the way the plan was being operated, both by the record keeper and internally, was not compliant. And there had been some 409A missteps. And the trouble with that is that these plans can be disqualified, or this participant basically their benefits could become taxable. And penalties are, unlike a qualified plan, penalties in a non-qualified plan are assessed to the participants rather than the company. And I was on a webinar like this with a head of HR for a major company, and she didn't realize it. And I kind of read that same bullet, and she like waved at me and said, "Oh, let's talk about this next week," because that's what people get fired for, is that our CEO or CFO they have to pay a penalty for a mistake in operations by staff. So that's a really important issue. I think if you've not looked at how your plan is actually being operated to make sure it's 409A compliant, that's real important. I see Jim's head nodding because I know he's had some experience with that. And so through that, we basically, through this diagnostic, set up a full mapping of their whole operational procedure to make sure that it was compliant, and there was checkpoints all along the way. Next slide, please. So basically, this particular program had an immediate improvement in P&L impact of about $1 million, and this was a smaller program. I think there was maybe $8 or $9 million in there, but over the first 7 years, there's about an $8 million improvement in asset values and P&L. The plan was improved to increase participation and satisfaction, and then basically we put in a very tight financial reporting and analytics program to basically cover the plan. Next slide, please. Dave, why don't you talk about this particular case study and what you've seen in the not-for-profit world, because I know we have some not-for-profit people on this call.
Yeah, and this would pertain to anyone that is on the boards for not-for-profits as well, of trying to solve solutions of retaining the talent at the top. This particular case was putting together a new compensation package for the CEO of a hospital. And the new compensation would have triggered a lot of excess taxes for that individual. And even when we did in the non-for-profit world, you got to deal with the 409A compliant and make sure that you don't exceed any of those limitations, et cetera. Also, as a short-term plan, was the effectiveness of, to recruit this person, retain this person, and reward senior management as they try to upgrade the staffing at this hospital to the greatest extent. And then additionally, that involved a provision of the 2017 that would impose a 21% excise tax on compensation. So if we go to the next slide, you know, this is the sample of what the package kind of looked like, with a salary of 500, bonus of 250, and then how do we take care of this other thing to keep this individual around and also put in control their tax situation, if you will. And you see 457 plan contributions, 200,000 a year for 5 years. Some of you out there were going, wait a minute, 457B plans have the same limit as 401k plans of 19,500, but there is the flexibility of doing deferred compensation here with nonprofits. It's what's called a 457F plan. And just like the other things that Ken had talked about previously, there is no upside limitations as to how they want to fund that. And 457F plans are usually tied to the employer contract and help to control a larger dollar figure, and also the length and tenure of the individuals that are placed under the F plan. So, you know, with that, in the 5th year, we were able to take out the tax contributions and spread out the receiving of those benefits. Anything you want to add to that, Ken?
Yeah, I mean, 457F plans were very prevalent, you know, 10 years ago. A lot of the large nonprofits had very, you know, good plans comparable to the types of non-qualified plans you had in the for-profit world. It was a great tool to recruit top management. The IRS has gutted those plans with a combination of 457F regulations, proposed regulations, as well as the 409A regulations. It becomes extremely difficult or impossible to really provide long-term meaningful benefits for senior management in not-for-profit organizations. Why don't you go on to the next slide? Why don't you go ahead and go all the way through there. There you go.
Yeah, go ahead, Ken.
One of the solutions that has been very effective is to use a joint ownership or split dollar type life insurance product. That's a high cash value accumulation product that's funded by the not-for-profit. It's jointly owned by the not-for-profit and the participant. And basically, retirement benefits are either targeted on a DB basis or done on a defined contribution basis with vesting and basically pay back to the not-for-profit. So if anybody wants any, details on that, we'll, be glad to get you, that information. I don't want to go in depth on that, but there is a really good solution there that can be used for these programs. Why don't you go ahead? This last one, it's a kind of a quick, interesting way to use a deferred comp plan. It was a private client of ours that was a pass-through corporation. It was a sub-S corporation. They were growing. They needed capital. Commercial borrowing, for a number of reasons, wasn't their best situation. So a deferred compensation plan for owners was set up so that their normal distributions were held in this plan and accounted for in the program, and their balances were growing. It wasn't funded. Actually, those dollars were used by the company for their acquisitions. Fast forward about 7 years later, they didn't need the capital anymore. They were able to generate it all internally. They were able to use extra, basically commercial lending, and most of the participants took out their distributions. The problem was one of them left their $30 million balance in the plan and kept deferring it. It was put in a rabbi trust, and Dave, as you'd mentioned, through mutual funds, which were taxable to the company. And this one minority, because of this one minority stockholder's $30 million balance, all the other stockholders, because it was a pass-through entity, were being taxed. It didn't really rise to the surface until one of their smart tax people said, "Well, wait a second, why am I paying tax on these funds for you, other stockholders?" So it was like, oh, we got to fix that. So basically, they put in a tax managed portfolio in the trust, combining We helped them combine both mutual funds and a little bit of corporate-owned life insurance. So that's kind of an interesting situation.
And Ken, that's a great point that you make. When you use taxable investments, you can't control the timing of the taxes. Because if you have someone that's been in the S&P 500 and, transferred $1 million and there's $200,000 a gain there, it's a surprise tax for them, and those things they can't. It looks like we're coming up on our time.
Yeah,
So
let me just take 30 more seconds. If you go to the next two slides off.
Yep.
There is generally a very structured and disciplined process for doing diagnostics of programs. Next slide. It usually covers these areas, design, operations, communications. You can look through that. You'll be getting, I think you've already been sent this presentation. These are the areas that need to be drilled down into in a planned diagnostic, and something you might want to think through.
The last thing I'll add to that is you slipped over on the last slide, but these programs really should be looked at every 2 to 4 years and analyzed to make sure that they are still meeting the goals and objectives and the current laws, and with the recent changes in 409A.
Absolutely.
And with that, I think we can wrap it up and open for questions. And Mr. Burns, I guess.
We're gonna launch our last polling question.
Oh.
Which is basically who's done one of these diagnostics in the last 3 years. So as you answer that, I'm going to turn it back over to the legendary Mark Burns.
Mark, this is where you're supposed to sing until they answer the poll question.
I'm going to save that for Saturday Night Rock Hall induction, when they bring on Carole King and all the great Tina Turner and Tom Rundgren and the rest of those cartoon characters, including Paul McCartney, who's going to be in town.
Exactly.
All right, well, that's a great segue. Let me just see if I can provide a quick summary. 64% of the participants today have claimed they have a non-qualified plan, but only 17% have taken a look at that inside of the last 3 years. So if you think about the last 2 slides that Brother Kirk went through, I think that in and of itself will give us a great opportunity to sit down and visit with you folks on that topic. For 36% of you that do not have a non-qualified plan, pick up the phone, call Ken, call Dave, call Jim, call me. We'll be happy to discuss with how you can reverse any discrimination against your highly compensated. You've learned today about the CAA, the changes in the rules regarding what they call Section 7702, dealing with life insurance, COLI. Let me tell you, there's been a lot of bad product that's been put in place. We'd be happy to audit and review that. Next, I think this was absolutely critical. We didn't really delve into this today, but those of you that are actively engaged in merger and acquisitions, understand this: what you may be buying is a 409A non-compliant program. Next, it may be unfunded. Next, you may be creating additional liabilities that you didn't think you were going to get when you, quote, onboarded this new code. So that's going to be pretty important, and you don't want to find yourself with any change of control lawsuits at the back end. That's kind of a quick summary, guys, of everything we've gone through today. We hope you have found this to be a highly productive and informative session. If there's other questions that we can address right now, I turn it back over to Steph, and we'll take it from there. And guys, thanks a lot for a great job today. Appreciate it.